This conference will now be recorded.
Hello, this is Eric Jorgensen signing on to do the risk management webinar. This is the first slide of these 10 things that I think everybody should think about doing in the coming new year, or any year really. So what you have here on the screen is just an overview of all my designations. I can certainly share more about that. If you're curious, you reach out to me. Let's get into the meat and potatoes. So the first thing the purpose of this slide is we want to talk about identifying the risks, making sure you're protected, and that runs the gamut for health insurance, disability insurance, life insurance, long-term care insurance. We're going to touch on property and casualty insurance. I'm going to do my best to keep this less than 30 minutes. Again, this is meant to give an overview. The deep dive can be done individually on an in-person meeting, or oftentimes I do seminars where I'm presenting, at a Mother's Rest. She has an inn in Newmarket, Maryland, where you can come out. I'll do presentations with the York Montgomery County or other nonprofits. Or we can do, if there's enough interest, I'll do a deeper dive on a webinar. So the first thing is, while you're live and you're working, when you're working, health insurance could be covered by the employer. Most of the time you're paying some kind of premium, maybe not that much. If you were to lose your job, or you could get COBRA, which would cover you for about 18 months. If you have children and family, it could cover them for a little bit longer, up to 3 years, but you're going to be paying a higher premium. And that's because you're paying the portion that the employer typically pays. So if you're paying $60 a month for health insurance, you might be paying $180 a month on your own. Medicare and Medicaid. Medicare isn't just for when you're 65. However, when you turn 65, Medicare Part A is going to be hospital insurance. Medicare Part B is going to be your medical insurance. You have to enroll in that and pay a premium. If you don't enroll at 65 and you don't have other health insurance, you incur a 10% penalty every year that you wait. So it's important that you sign up for that. The premiums for Medicare Part B are they're going to look at your income for the previous 3 years. So in 2020, they're looking at what you made in 2017 to see what the premium is going to be. There's ranges. I'm not sure of the exact amount. I think it's $180, $190 a month or something for the basic level, but I'm not sure. Don't take that as gospel. And then if you make above a certain threshold, your Medicare Part B premiums are going to go up. Part C is Medicare Advantage or Medicare Advantage plans, where instead of having Medicare Part A and Part B, you do a Medicare Advantage plan and it covers your Medicare Part A and Part B. Part D is going to be your health insurance, your prescription drugs rather, and then you can have Medicare supplements or Medicare gaps, where the different Medicare F or Medicare G or something else like that, where it'll pay for different things based on what the supplement is that you're purchasing. I encourage you, if you're going to really curious about Medicare, the company I really like is Boomer Benefits. They do a great job. They have a lot of webinars, a lot of resources on their website, and they're the only company I've been able to find that has a service department in addition to a sales department. So if you're at the age where you're looking for, should you get a Medicare supplement or should you do a Medicare Advantage plan, they can talk you through all that. Now, I said earlier, it's not just for people 65 and older. If you have an adult child who is receiving disabled adult child benefit, SSDI, 24 months after they start receiving SSDI, they qualify for Medicare automatically, which means they may need, or you may want to get them, a supplement plan. And that means they could be in their 20s or 30s, not 65. And again, you would want to look into finding a professional to really pick what works for that individual. And then Medicaid is for the poor or disabled. That's so if you make less than certain income thresholds, if you have less than $2,000 in assets, some states it's lower than that, you qualify, and Medicaid will pay for everything. But you have to find a provider that accepts it. You can have Medicaid and Medicare at the same time. You could also have a private health insurance, Medicare and Medicaid. And, in my case, my son has my health insurance, which he'll have the rest of his life. He has Medicaid, and come July, he becomes eligible for Medicare. So it's possible to have all of those. Each one would serve a different purpose, pays for a different thing. Medicaid could pay the Medicare premium. So there's just a lot of options. The important thing is to make sure you have health insurance, and as a parent, to think about will your health insurance end for your child at 26, or will your company allow you to keep the child on your health insurance if you can prove they're permanently disabled? The one that comes to mind, the biggest employer in my area here in Maryland, is federal government. If you have a federal employee, if you're a federal employee and you have a child with a disability, you may be able to keep your child on the health insurance beyond age 26. So that's something you want to look into for your employers. If you have a child if you don't have health insurance and you have a child under the age of 18, you can apply for Medicaid on behalf of the child. If at 18, if the child qualifies for SSI, in many states they automatically qualify for Medicaid. These are things where you should be thinking about getting engaged, moving forward. And these are all things myself, Planning Across the Spectrum, can help you with. Your financial advisor, if you have one, should be asking you these questions. Not every financial advisor understands the challenges of working with families with disabilities. They may be great at helping you plan for your retirement, but maybe you need to bring us in to help you with the disability planning. That's my one and only plug for that in this. So going forward, let's talk about the next one. Protecting what you own. Now, this is wine. If you're like me, it's unlikely you have a wine cellar, but you probably have something that you value or that has value that's been more valuable than, say, $2,500. That's my threshold. If something's worth more than $2,500, diamond engagement ring, gun collection, something like that, Beanie Baby collection, not that I think they're worth anything anymore, but for example, you would want to look into getting a valuable item insurance policy through your property and casualty agent. Property and casualty agents, those are the people that sold you your homeowner's insurance, your auto insurance. Some of you may already have an umbrella insurance policy. Many of the people I'm talking to do not. They're not familiar with it, or they think it's just for rich people. So let's talk about homeowners real quick. Homeowners policy covers the property, the house, and any outbuildings, a shed or something like that, a barn that you may have on your property. But you have to make sure that those outbuildings are called out in your policy. Don't take it for automatic assumption that the insurance agent knows that you have these things. It could also protect if your dog bites somebody or something like that. You want to make sure the things that I'm looking for when I'm talking to people are, do you need sewer and drain backup? So if something happens and the pipes burst or come back into your basement, flood out your basement, are you protected? Or do you have replacement value of your home? Things like that. I'm not an expert. You're going to want to talk to an expert, somebody who's very familiar with property and casualty insurance. Most of the agents I've met, they're not out to get you. They're out to make sure you're protected. Same with auto insurance, right? I mean, too often I've seen people who just want to get the cheapest premium possible and putting themselves at a lot of risk. You get hit by somebody who's underinsured or uninsured, and now you're on the hook for it. But if your insurance doesn't cover everything, you could still be paying medical bills out of pocket. So on the one hand, yes, I definitely think we need to be cognizant and aware of how much money we're paying in premiums. On the other hand, don't be a penny wise, pound foolish, right? Don't be so focused on how much you're saving. Oh, I saved myself an extra $600 a year, but you're taking on so much more risk. Really be clear what you're paying for with your insurance policies. The umbrella policy, I think everybody should have one. It should equal at least your net worth. So if you have a net worth of $1 million or less, you want to get $1 million umbrella insurance policy. They're typically not expensive. They're typically you know, maybe a couple $100 a year. If you get a $2 million policy versus a $1 million policy, it's not going to be that much more expensive. But you don't need a $2 million policy if you have a net worth of $500,000. You know, you just really want to protect what you have. It's not on here, but you want to think about renter's insurance. Again, if you have a family member, they're in a residential program, or you have kids that are away at college, living in dorms, they should have renter's policies to protect their electronics or their items. If something happens to that, the dorm and the organization that has the residential facility are not on the hook to replace personal items. That's where having a renter's insurance policy can't hurt. If you own rental properties, it would probably be a great idea for you to require your tenants to get a renter's insurance policy. I would certainly encourage that. So that's just a brief overview of how you can protect what you own. Next, we're going to get into what happens if you can't work anymore. So the big things are disability insurance and Social Security disability. Disability insurance is typically provided by the employer, but if you're self-employed, you're going to want to make sure you get yourself an insurance policy. You may not need a short-term policy. Most of those are good for, 7 days to 3 months, maybe 6 months at the longest. If you have a pretty solid emergency fund, or you have you believe you have enough cash on hand to last you 3 months, maybe not spend the money for a short-term insurance policy. But if it's free from the employer, go ahead and take it. Long-term is more important. Long-term policies through employers typically pay between 60 and 66% of your income, and it's taxable. So if you're making $100,000 a year, the long-term disability may pay out at $66,000, and then that'll be taxed. So maybe you're bringing home about $45,000 a year. So what you want to think about is if you're bringing home, for simple math, $6,000 a month, right? Can you live off of $3,000 a month, which is what your long-term disability would be? If the answer is no, you might want to look at getting a supplemental policy and then figuring out where you would have to cut the costs. Supplemental long-term disability policies, they're only going to bridge the gap from 60 to maybe 80, 85%, and not everybody's going to be eligible. That's where your financial advisor, your insurance agent can help you. That's what the private means, is buying your own policy versus getting one from the employer. If you have to pay for the insurance to the employer, I think it definitely warrants going out and looking to see if you can get it less expensive with similar benefits through an insurance agent or a financial advisor, and seeing what they have. Social Security disability, very, very difficult to get. You have to prove you cannot do any meaningful employment, and you have to show that the disability is going to last at least 6 months, which means you're not going to get a check for at least 6 months, probably longer than that. It's very difficult to prove, and it's really, I would say, a benefit of last resort. I would definitely want to see you getting disability insurance before you rely on Social Security disability. And if you do have disability insurance and you file for Social Security disability, make sure you know if your disability insurance is going to have an offset for the disability insurance. Because if they don't and they keep paying you, you might have to pay that insurance company back, and you don't want to do that in a time when you're already out of work and you're really relying on this disability income. So make sure you know what that policy is. If you're thinking about filing Social Security disability and you have a disability insurance policy in force on you already, talk to a financial advisor, get it looked at. And of course, what comes after injury but death, right? So when we talk about death, mitigating the impact of having you die, life insurance is the most obvious. It's also, in my opinion, the most efficient and cheapest way to fund a special needs trust. Life insurance, you have term and you have permanent. In most cases that I'm working with, if you have a child with a disability, I'm typically recommending that you have some kind of mix of both. I myself have a mix of both. I have a term policy that I bought to cover my mortgage. I didn't buy mortgage insurance. I want to make sure I clarify. I bought a life insurance policy and with a death benefit high enough to pay off the mortgage, and then I have my permanent insurance, my whole life insurance, to provide for my son. Another option could be annuities. If you're not insurable, you might want an annuity that would pay you a steady check, and it continues paying either your spouse or somebody else when you're gone. That's something, I'm not going to get into the weeds here. That's going to require a lot more individualized planning. You're going to want to talk to a financial advisor. I really don't think anybody should buy an annuity without talking to a financial planner who can give you some unbiased advice, about why the annuity may or may not fit for you. I personally don't find a lot of times where they're a great fit in the families with children with disabilities, but I'm not a financial planner anymore. I don't know your circumstances. I just want you to know that they're out there and they do have survivor benefits. The military survivor benefit is great. Back in 2016, they made it so adult children with disabilities can qualify for the Survivor Benefit Plan, SBP, Sierra Bravo Papa. And what that means is your child could get up to 55% of your pension. So if you're bringing home $1,000 a month in pension, your child could get $550 a month. The only caveat is it would have to go to a first party special needs trust. Now there is a cost. The cost would be 7% of your pension until you turn 70 and you've made 30 payments. I believe it's 30 payments. The trick there is understanding, even if you've made the required number of payments, they're gonna have you continue paying until you're age 70 unless you die. You do need to make sure you submit all the paperwork to get your child found to be permanently disabled, and you're gonna want to resubmit that. I believe it's every 4 years, and every branch has a different person, a different place that needs to be submitted. So you're going to want to verify where that is. If you're Air Force, it's going to go somewhere different than if you're Navy or Army. Pension survivor benefits. Many pensions allow you to pass money on to a spouse. This is another opportunity for you to see, can you pass it to your disabled child? Federal government, you can, if it doesn't exceed the Social Security disability benefits they're going to receive. There may be some other states out there I'm not familiar with, but you're going to want to look into those. The last thing I want to touch on real quick is, what if you don't die? And what if you're not disabled? What if you have a much more debilitating, disease, or like Alzheimer's, or perhaps you have something where you're no longer able to do two of your activities of daily living. In the worksheet that I'm going to provide to this, it covers what the 6 different activities of daily living are. To qualify to use long-term care insurance, or to qualify for long-term care, you need to be unable to do 2 of those activities of daily living, or be found mentally incompetent. Now, long-term care insurance is expensive. It's best bought probably in your 50s, I think, would be the sweet spot. You don't want to get it too young. I'm not a fan for families like ours to purchase long-term care riders on life insurance, because the life insurance is meant to fund a special needs trust. If you have a rider with long-term care insurance and you use that long-term care insurance rider, you're decreasing your death benefits. So let's say you have $1 million policy and then you need long-term care, and you use $600,000 from that life insurance policy to pay for your long-term care. Well, now instead of leaving your child $1 million, you're only leaving them $400,000, which may or may not be enough to provide for them. Odds are, if you had bought $1 million policy, it was because you needed $1 million to care for your child, and $400,000 isn't going to be enough. So I would encourage you to look into other options for long-term care. And again, this is where you would want to talk to the financial advisor. Maybe it makes sense to take your risks by using Medicaid when you bleed down your assets, and have Medicaid pay for the nursing care facility if you need it. It should be noted Medicare will not pay for nursing homes. If you're a veteran, you may qualify to stay in a armed forces service home. They also have nursing homes and long-term care benefits that you may be able to get if you qualify through the VA. Definitely something to be worth looking into. So that's everything I'm going to talk about. The questions and answers. If this had been a live webinar, I would have prompted, solicited questions. I was originally going to release these once a week. I will probably release this one tomorrow, and then do a second one on Monday, and then release them every Monday and Friday. I want to get them out there. I know people have questions. I know there's, in this time of uncertainty, there's just so much going on. This is how you can get a hold of me. I am based in Frederick, Maryland. However, I serve clients in all 50 states. I was doing that before the coronavirus. A lot of what I do is virtual, GoToMeeting, phone, Zoom, Skype. I'm more virtual than I am in person, and I'm happy to get back to you. Email is the best way to reach me. However, if you want to call the office and talk to Andrew, the number's up here, 1-855-AUTISM2. If you don't have a phone where you can actually look at the keypad and see what the letters spell out, the phone number is 1-855-288-4762. I hope this has been helpful, and I look forward to hearing from you. Any feedback you have, I'm happy to take it. I had surgery for a melanoma removed, hence the scarring in the face. This is the worksheet I was referring to. It's a 2-page worksheet. It doesn't have everything I talked about. However, I do think it does a great job. Of course, I think it's because I wrote it, but I do believe it does a great job outlining what I talked about. However, you guys are the judge. I mean, if you read this worksheet and you're like, "Hey, Eric, not enough detail. We really want more," then let me know. I'm happy to get that to you. Otherwise, best of luck to you all, and I hope to have the next webinar published on Monday.